Today's RBNZ announcement was largely in line with our expectations. The Reserve Bank cut the OCR by 25 basis points, taking it from 3.5 to 3.25. So that brings the total cuts to 2.25% over the last year. One thing we would point out, of course, is that the Reserve Bank is now very well advanced in their easing cycle. And even though it was largely in line with market expectations, for a terminal rate of 2.85% versus market expectations of 2.9, things were very similar, but there has been, a reasonable market reaction in terms of the 2-year rate being about 15 basis points higher and long-term bonds being 7 to 10 basis points higher. And I guess really that's a factor, the realisation that we are, largely through the easing cycle, and whether we continue to cut rates lower or do hold them lower for longer very much depends on how things evolve in the future, and there's very much a high degree of uncertainty, particularly around events that are coming out of US policy, etc. So there were a couple of surprises. Probably the first one was that they put things to a vote. So previously under Adrian's leadership, they generally reached consensus. Today the vote was 5-1, so 5 people voted to cut by 25 basis points, and 1 person believed that they shouldn't be cutting interest rates at all. So perhaps it was somewhat a surprise, and also for the first time in 5 years they provided a range of scenarios in the monetary policy statement. So typically you'd get like a central or most likely base case scenario, and that's just a reflection of how uncertain things are going forward in terms of the impact of tariffs and how that will spill over to us in New Zealand. So we've been positioned with a longer duration for quite some time, and what that means is we buy longer maturity bonds to lock in higher rates for longer, and if rates move lower, then of course we get a capital gain on the portfolio. As I said earlier, we are coming towards the end of the easing cycle. So, going forward, we may start to dial back the length of the maturities that we put into the bond portfolio, and then look for other types of assets in the cash funds that generate a higher yield, things like floating rate notes, etc., without necessarily locking in rates for 1 year plus in the short-term portfolios. I think in terms of what happens, this is very hard. No one has a real life crystal ball. So there's a lot of uncertainty around there, particularly around what's happening in terms of US policy in relation to the tariffs. So you've seen quite an abrupt, U-turn. The tariffs are provisioned against China, etc. So there are some big things in play. New Zealand is like a small open trading nation, so we're very leveraged to what's happening in the rest of the world. So I do have quite a degree of sympathy for the central banks, and the way they're handling it, I guess, is providing a range of policy projections rather than a central forecast going forward, because no one is sure. But in short, we just have to wait and see how the data evolves going forward, and then the Reserve Bank still has room to lower interest rates further if need be, if the New Zealand economy does slow down more than what's expected. I think mortgage borrowers have been hopeful that we're going to see some further moves lower in rates, and the Reserve Bank did actually comment today in the press conference. They said their central projections were mortgage rates to be around that sort of 5.5 to 5%, and you'll see today the 1 year specials are 4.99 and have been there for some time. From the Reserve Bank's, I guess, language, it sounds as though they're not really putting pressure on the banks to actually pass through lower interest rate cuts to borrowers. But what they did say is that probably the greatest impact will be if we see more competition amongst the banks to grow their share of their mortgage lending books, because system growth has been quite low at the moment. So there's not a lot of, I guess, residential borrowing or institutional borrowing as well. So if they want to try and grow the share of that lending market, then maybe banks will drop their interest rates modestly, but I wouldn't be too optimistic on that either. So we just had the budget out this week, and the Treasury forecast a little bit different from the Reserve Bank. Primarily that Treasury sees the cash rate going lower and staying at a lower level for longer, and also the more optimistic in terms of their growth forecast. And without getting into the political side of things, by itself that does make sense that, if you want to have a higher level of growth in the economy, which flows through to, greater revenue receipts in terms of tax take for the government, then you're more likely to achieve that with a lower or more stimulatory cash rate. But when you look at, the Reserve Bank's forecast, I guess they're forecasting what they think is most likely to happen. So there is some divergence there. So the Reserve Bank has cash rates not going as low or staying as low for as long as what Treasury does. Yeah, I think if I had to use one word to summarise things, that would be uncertainty at the moment. The New Zealand economy has been recovering, albeit at a very modest pace. Of course, the Reserve Bank's mandate is solely on inflation. Inflation expectations have ticked up, but over the medium term, the Reserve Bank is confident that inflation will return to the middle of the band. So that does give them, further room to lower the cash rate to a more stimulatory level if necessary. And I think we just have to, wait for some water to pass under the bridge and just see how, some of these, I guess, significant things in play do pan out in terms of, what's the overflow from, tariffs to us here in New Zealand, some of the geopolitical things as well. How do they play out? And then, of course, it's the shape of the recovery. If cash rates sort of stop here around neutral 3, then of course you're going to have a more gradual and slower recovery. If cash rates continue lower, I mean, that's probably only going to happen if we have a further deterioration in growth or activity going forward. But there's a more likelihood that I guess you'll have a more V-shaped recovery.